We are here today, well, most all of us, to find out about what the commercial market looks like now and what we can expect moving forward. To provide us with that information, we were thrilled to have the chief economist of the National Association of Realtors here with us, Dr. Lawrence Yun. Due to an early northeastern snowstorm and canceled flight, nothing to do with any type of global warming because it does not exist, he cannot join us today except on FaceTime. Our theme this year is Why Charleston? We'll hear from Dr. Yun first, then we'll go a little more in depth to the Charleston market by finding out what made several developers invest their own money into our region and bring their own expertise along. Dr. Yun creates NAR's forecast and participates in many economic forecasting panels, among them the Blue Chip Council and the Harvard University Industrial Economists Council. He appears regularly on financial news outlets, has testified before Congress, and has appeared as a guest on C-SPAN's Washington Journal, as well as columnist on Forbes' website. Dr. Yun received his undergraduate degree from Purdue University and earned his Ph.D. from the University of Maryland at College Park. Both of my parents and my sisters went there, but they did not get a Ph.D. Dr. Yun will provide an overview of the national and regional economies as they pertain to the commercial market. Thank you for sort of joining us today, Dr. Yun.
All right. Okay, great. Sorry that I cannot be there. In the 30 years that I've been in Washington, this is the first time there's a snow before Thanksgiving. So the flight was canceled. It is a pity that I wanted to get a good flounder over at Hyman's restaurant in Charleston, where I've been there many times. But let me give you the outlook. I'm glad that technology is working. And overall, the South Carolina economy, in Charleston specifically, are in a very good shape. If you look back, this conference event has been for 15 years, but if you look at 10 years ago at the downturn, at the depth of the Great Recession, many people are wondering, how long would this recession last? Can I survive through this time? Fortunately, the economy climbed out of that mess, and now we are seeing a strong activity. You should be seeing a good business opportunity, but what is ahead? So going to the next slide, which shows the gross domestic product. This is the total production in the country, corollary, total income generation in the country. One thing to note in this chart is that there are gray shaded areas which correspond to economic recession. And we have not had a recession for almost 10 years. Again, last time being the Great Recession. So some people naturally begins to ask the question, given that economy always goes into a recession at some point, are we due for one? And from my perspective, I don't look at the just timeline. I have to know possible triggers for an economic recession. And there are not really that many triggers present. Some people said maybe rising oil prices could trigger into a recession. But America has become the largest oil producer in the world, and therefore I don't anticipate any major shock, high oil prices, high energy costs in the upcoming year. The other possibility is over leverage, over borrowing, especially by businesses and consumers, and that is not the case. We don't have the subprime lending. Companies are flush with cash. They are not borrowing excessively. So we don't have that condition. And possible third reason is just loss in confidence, where psychology can snowball into pessimism and lead to economic recession. But you look at the confidence level of businesses as well as confidences of consumers, and it is close to all-time high. And therefore, the indicator of potential triggers for economic recession is just not there. Just to give one example, Australia have not had an economic recession for close to 25 years. So just because we are running into long economic expansion does not automatically means that we are due for a recession. So going into 2019, and and possibly into 2020, I believe there is a sufficient momentum that economy will continue to grow. South Carolina always outpaces the rest of the country, which means it is in even better shape. Now, beyond 2020, it's difficult to make a call at the moment, so we have to wait and see, but at least over the next couple of years, things appear to be fine. Moving into the next slide, which shows the annual GDP growth rate. So it's the same chart, but put it in a percentage term. The first quarter was at 2.2, second quarter 4.2, third quarter 3.5, and fourth quarter looks close to 3%, which means that for 2018, it may be the first time in a long while where we actually exceed 3% in terms of GDP growth. If you remember President Trump, or I should say before the presidency, when candidate Donald Trump, he was saying that if he's elected to the presidency, that he can bring the GDP up to 3%. In a sense, you can say that we will achieve that 3% or better than 3% growth in 2018. So the economy just rolling along very nicely in terms of GDP growth and the income generation. The consumer spending, which is the next chart, is very solid at 4% growth, and this is just coming from more jobs, and as people are generating income, they have the ability to spend money. Another thing that is fueling consumer spending is growth in overall wealth condition, a combination of rising home values, as well as the stock prices. Stock prices in recent months has been wobbly. But if you compare it to 1 year ago, I believe it is still ahead of last year. And if you compare it to 2 years ago, it is well ahead. And if you compare it to 3, 4, 5 years ago, you can say, well, if you invested in the stock market, you have become rich. So even though there's a little wobble in the stock market currently, it has provided a tremendous wealth for those long-term investors who have invested, say, 3, 4, 5 years ago. So consumer spending should continue to chug out solid gains going forward. Next slide shows the record high wealth, again, combination of housing as well as stock market. So that little downturn that you see recently, so even with the wobble in the stock market, you can still say it is up substantially and certainly much ahead compared to the Great Recession period back in 2009. Next slide. Shows that companies are in well position. This is part of the corporate tax rate cut that happened, part of the tax reform package last year. So companies are flush with cash. They have the opportunity to spend money. They do not need to borrow. Again, borrowing would be one of the potential causes for recession, but with corporate profits so high, they do not have to resort to borrowing, and hence there is not that trigger, at least from the company's perspective of over borrowing. Next slide. So business spending, particularly the recent quarter, was a little down, I should say weak, soft. It is positive, but not very robustly positive, and certainly not corresponding to the high corporate profits that companies are experiencing. One reason could be maybe they're awaiting the political election outcome to make the business decisions. The other possibility, and this is a real genuine possibility, and I mentioned about the potential triggers for recession. If there is one potential source, it is a trade war globally. So anytime an import and export decline, that leads to just bad situation for, say, Mexico, bad situation for China, but it always brings the boomerangs back into the U.S. and it causes recession into the U.S. So if there is a trade war through higher tariffs, that could be one source of major concern and possible trigger to an economic recession. I know there's a lot of rhetoric coming out of White House. If President Trump is using tariff threat to open up China, negotiating point, that will be all good as we can export more. But if somehow the higher tariff leads to reciprocating tariffs from other countries and leads to trade war, then Boeing will sell fewer airplanes abroad. BMWs cannot be shipped abroad. And in fact, BMW and Mercedes are thinking of possibly relocating their plants into other countries if there is a true tariff war, and that would impact South Carolinian economy. But if the current talk is more for negotiating point and it opens up China, then it would be all for the better. But we have to wait and see. But right now, business spending is not rising in proportion to corporate profits. Next slide. National defense has been a contributor in recent quarters. You can see that in the middle portion of the graph, the hollowing out of the defense spending. So defense spending was being cut in a major way. In the intro, they mentioned about my undergraduate degree, graduate degree, but the high school I attended in Columbia. I graduated from Irmo High School. My first Thanksgiving meal was at Fort Jackson military base in Columbia. But the military spending condition, again, you can see in the chart, was drastically reduced, but now in recent quarters it's being boosted up. And that is a positive contributor as you are building tanks or military jet generates jobs. So that has been a positive contributor to economic growth in recent quarters. Moving into the next chart, this is the import and export. Consistently, generally, import outpaces export growth generally, and that's why we have trade deficit. But part of that reason is that we have this extraordinary privilege of having the U.S. dollar. When there is a little trouble globally, everyone wants to hold the U.S. dollar, not Mexican pesos or Chinese yuan or other currency. They want to hold on to U.S. dollar. That makes it stronger, which means that American goods become more costly to export, while the imports that we purchase, foreign-made products, is cheaper. So import rises. So this is always where we have this trade deficit, but that goes along with economic growth. So just repeating what I had said earlier, if President Trump is trying to negotiate a better trade deal, because China is cheating, without a doubt, it will be all the better if we get a better deal. But if we don't get a better deal, but just leads to trade war, then it will be bad for China and it will be bad for America eventually. So import and export overall condition, we have this trade deficit, and let's hope for a better negotiation and trade deals. Now, the part of the tax reform was not free. So good that companies are getting bigger after-tax profit, consumers have higher after-tax income, but the national debt is rising and rising. Every day, 10,000 Americans turn age 65, meaning they are receiving Social Security benefits, Medicare, and that is boosting the government entitlement spending, so the debt level is rising. So far, it's not impacting interest rates. It's not impacting economy negatively, but economists are always concerned at some point that could be a trigger point. But so far, it doesn't appear to be the case. Right now, Venezuela is blowing up because their debt level is extremely high. Greece would blow up if they did not get help from Germany. But at the same time, Japan has even higher national debt than the U.S., yet Japan is very stable, low interest rate environment. So we have to see how everything plays out. But so far, national debt that is rising appear not to be impacting economy in any measurable way. Skipping to the next slide, the national debt to GDP, again, is at 100%, which economists would say that would be generally concerning. But if we look at Japan, where it is 200% to GDP, Japan appears to be doing fine. Next slide. The unemployment rate, you all know that it is extremely low condition. When I took Econ 101 for the very first time, it says that in a free society where workers have right to quit their job and search for something better, and companies have right to fire incompetent workers, there will always be unemployment rate. So what would be considered normal? And I always understood to be maybe 5 or 6%. Today, we are well under that. And maybe the internet age where people can search jobs through LinkedIn it's sitting on their desk. So maybe it's possible to have lower unemployment rate as being normal, but this is a very good for the economy, very low unemployment rate. Next slide. We have low unemployment because jobs are being created, 103 straight months of job creation. But more interesting for you is the next slide, which shows the Charleston Metro total jobs. So you see that back in the year 2000, about 260,000 jobs. Today, 360,000 jobs, essentially adding 100,000 more jobs to Charleston economy over this time span. And in terms of percentage growth, it is 3 times as fast as the national growth rate. Boeing coming in and manufacturing, but the port activity, all the import and export, Panama Canal expanding, all that is helping. So Charleston clearly one of the stars for the country in terms of job growth, and that's why you are seeing a greater commercial real estate business activity. Going into the next slide, let me just skip that one for the sake of time and move on to the next slide. Construction workers is one area where we have not fully recovered. So even though the total jobs are much higher, we are not reaching record high in terms of construction workers. And that's why you are seeing some shortage of inventory availability, whether office spaces, the warehouses, because we just simply cannot build, or even residential housing because of the worker shortage. We are working with many of the local government about ideas about how to train for more construction workers using community colleges or even vocational training in high school because we are greatly short on the construction workers to fully satisfy residential real estate demand as well as the commercial real estate demand. Next slide. And right now, the construction wages are rising much faster than other industry wages, yet even with higher wages, the recruitment has become very difficult in the construction industry. Next slide. The interest rate environment. We know that the Fed is raising interest rates, so short-term Fed funds rate is rising. There's likely to be 4 rounds of rate increase till end of 2019. Maybe one in December of this year, 3 rounds next year, but most likely 4 rounds in some fashion over the next 13, 14 months, which means that if you are borrowing money at prime rate, be prepared for interest rate adjustment. It's also pushing up long-term rates, which means that cap rates will also be pressure to rise, which means either you have to extract higher rent or property prices, if you have to sell, may have to be reduced somewhat because we're in this rising interest rate environment. But to put it into perspective, mortgage rate rising to say 5.5% next year, those are still historically very favorable interest rate environment. Next slide. This is the home price index. I know it's not commercial, but many of you are homeowners and you may want to look at what your house is doing. But also this is an indication about the strength of the Charleston economy. You can see there's 3 major cities, Greenville, the upstate, Columbia, and Charleston. 3 graphs, and Charleston is the booming one. The green is Greenville, red is Columbia, but you can see even within South Carolina, Charleston clearly is doing far above the rest of the state in terms of the economy, and home prices is a reflection of that. Someone who purchased their home in 1995, essentially a little over 20 years ago, they would have seen that home values essentially be 3.5 times higher. So very good return for residential investment, but this is coming due to the fact that very good solid economy. Next slide. Right now, the home sales are slowing somewhat. I don't think Charleston is slowing down any bit. I think Charleston is actually matching up with last year's figures, but this is coming from rising interest rates. What we need right now is greater inventory conditions, and this is the overall single-family housing starts. So anyone who is doing land development, there is a still need for greater housing starts. So any commercial practitioner in land development, this is still an opportune time to get in because there is an inventory shortage and the building activity is not yet back up to normal. Next slide. Multifamily, in the meantime, has been very robust. You may begin to see some rising vacancy on some apartments just because of the robust building activity in the apartment sector. Next slide. Now let's focus on the commercial real estate. Next slide. Commercial property prices has outpaced residential prices. So you saw the Charleston residential prices rising very strongly. But if one overlays the commercial real estate prices, it has risen even faster, meaning better return on the investment. Next slide. Between some major markets, meaning that Washington, San Francisco, Boston, Chicago, versus more second-tier market like Charleston, Nashville, Orlando market, the major market prices have risen even faster. And I would say that there could be some price correction in commercial real estate in major markets, but not in the second-tier markets like Charleston and Nashville. I think second-tier market prices will hold on better, but the cap rates in the New York City, Washington area have been driven so low. In some property, cap rates up 3.5%, 4%. In a rising interest rate environment, the cap rates will have to rise and buckle the prices downward. But Charleston, I would say, is on much better ground compared to, say, the bigger cities. So there is less concern about any price decline. And if there is a price decline, it will be very modest condition because you have the good economy strength and the rental income is good. Occupancy rates are being very high. Next slide. So this is the overall cap rate trend. So expect cap rates to rise in 2019 as the overall interest rate environment begins to rise. Next slide. Commercial investment activity of large properties that is valued at $2.5 million and over. It has been coming down over the past couple of years, and this is because the sellers and buyers cannot agree on price. We are in a good economy, but the property sellers of office building, warehouses, apartment buildings are saying, in a good economy, high occupancy, I do not want to reduce prices. While the buyers are indicating that even though the money is available, they do not want to pay at that cap rate. So they cannot agree on price. So we are seeing somewhat of a reduction in transaction on these expensive properties. But most of the commercial real estate practitioners do not sell property that is $2.5 million and above. It is below that amount. And if we go to the next slide, when we ask commercial realtor members, is the investment activity rising or not? And they're saying it is still growing. Maybe the growth pace has slowed somewhat, but it is still growing. So unlike, say, $2.5 million property, the more, say, $500,000, $1 million property, those transactions are still rising, which means that our members are participating in greater business on that. Next slide. Let's go now into the forecast. What to expect in 2019. So going into the next slide, the table, economic forecast. As I mentioned, I don't foresee economic recession in 2019. There is not that trigger. Only exception is trade war, but I think President Trump is not really thinking of trade war. He's looking for better negotiation, or at least I hope that is the case. The consumer prices appears to be very moderate. Nothing alarming in terms of consumer prices, especially the latest month when the oil prices really tumble down. I mean, that will begin to lower consumer prices. So I think that is overall contained. But the 10-year government bond, next to the last row, you can see that is rising. which means that longer-term borrowing rates will also rise. Cap rates will also be pushed up as well because of this rising interest rate environment. Next slide. Related to commercial real estate forecasts, broadly speaking, the office sector is undergoing some transformation in terms of employers using different space layouts, especially for millennial generation, where they are saying you don't need an office space, you just need a large dining room table, and you just come in, bring your laptop in, and therefore, even though employment has risen, it has not led to commensurate rise in the office occupancy demand. So the vacancy rate should remain very steady and not really going down. But the industrial sector is where it's been outperforming rest of the commercial sector. So all this internet, online shopping activity through Amazon, the need for warehouses, and also the import and export. Anytime there's an import-export, one needs to storage those items that is being transported across the globe. And hence, the industrial sector is doing very well. Vacancy rate expected to continue to decline. The retail sector holding on. Multifamily may see some increase in vacancy rate because of the overbuilding that occurred. I think I'm nearing the end. Yes, actually, that is the end. So the overall outlook, again, is that the economy, no real trigger for recession. Consequently, occupancy will do well. If you are involved in leasing, no worries. Continued leasing activity will be very robust. But if you are involved in transaction, that's where there's some question about pricing with the rise in cap rates. But I think Charleston, we should hold steady while the major market like Washington, D.C. May see some price reduction in the commercial space. But overall, I think your business activity should do very well. So thank you for listening, and thank you for inviting me to participate in the event.